Today we are joined by Romy Acosta, Head of Investor Relations at JOST Werke SE. JOST is a global leader in safety-critical systems for commercial vehicles, serving the transport, agriculture, and hydraulics markets through brands including JOST, Rockinger, Tridec, Quicke, and Hyva. Today, Romy presents the first half 2026 financial results. Romy, the floor is yours.
Let's start with a quick overview of our results for the first half of 2026. In the first 6 months of the year, JOST grew by 12% compared to the prior year to 857 million euros. And organically, like for like, we grew by 9% compared to last year. In the business lines, the biggest growth came from the agricultural business line, in which we grew by 23%. 22% of that was organically. Then the hydraulics business line grew by 20%. However, there we still have a bit of an M&A tailwind, 39 million euros from the acquisition of Hyva, which started to be consolidated in February of 2025. So the January of this year was still an M&A effect. Adjusted for that, organically, we grew by 6% in hydraulics business line. And in transport, we grew by 4% and organically by 6% compared to last year. So very broad growth across all business lines, underlying the important effect of our synergies and the cross-selling across the different business lines, especially in agriculture and in hydraulics. From an operating point of view, we managed to further increase our profitability, given the synergies from the Hyva acquisition, and achieve an adjusted EBIT margin of 10.3% compared to 9.5% last year, for the highest adjusted EBIT in the history of the company in the first 6 months of 88 million euros. If we look into the regions, here we will see as well that we also grew not only in all business lines organically, but also across all regions. In Europe, as EMEA, we grew by 9% organically, 5.6%, 409 million euros. And the margin was at 6% to growing the EBIT by 9% to 24 million. Here is to keep in mind, we did adjust our business model across the region. So part of the earnings that were before being sales and earnings that were before being consolidated through EMEA are now directly rooted by the regions where the sales are done in Americas and APAC, which is why you see a shift in profitability from EMEA to Americas and APAC. On the overall group level, that will, going forward, reduce complexity. So that is actually good for the group. It gives a bit of a shift compared to prior year towards the other regions. In Americas, we grew by 11.5%, also 10% organically. And this is really important because the US market was still down in the first half of the year compared to last year. So a lot of this growth has been through market share gains and new projects that we've won with new customers, both in North America, but especially in South America, growing our business in hydraulics and in agriculture. Adjusted margin was also at 12%. And earnings adjusted EBIT grew by 24% faster than sales to 27 million euros. Also in the APAC region, we achieved the biggest growth in the region, driven by China, but also by India, growing 19% reported and 15% organically. And the adjusted margin improved to 15.4%, already showing some of the synergies, especially in that region where the Hyva acquisition is the strongest. Adjusted EBIT grew by 30% to a total of 34 million euros. So overall, a very good start to the year, a very strong first half of the year, the biggest that we've had so far in the history of the company, which led us to confirm our guidance for the full year. So we are very happy to see that our organic growth and is delivering through diversification. We're gaining market shares, new customers in all regions and all business lines. If you look at the last 12 months figures, which also include the Hyva business, you see the synergies showing by a 6% growth in sales and adjusted EBIT outpacing that growth, with adjusted EBIT margin for the last 12 months already at 9.8%. And here, the more the synergies come along and we are in line with our plans, the faster we'll get to the 10% corridor that we want to achieve. Also, very strong improvement in the ROCE, 3.5 percentage points compared to prior year, showcasing effective capital allocation only 18 months after the biggest acquisition in the history of the company. We were at 17 million free cash flow in the second quarter of the year and are starting to reduce the working capital build-up that we have in the first quarter. And we expect that this trend will continue in the second half of the year as well. So overall, very good first half of the year. We look forward to the second half. The markets should be more supportive in North America as the demand for trucks and trailers start to improve. And thank you very much for your interest. If you want to learn more about JOST, you can always reach out to us directly. And thank you for your attention.
Thank you, Romy, for presenting JOST's first half 2026 financial results. Visit Seat11A to discover financial results presentations, elevator pitches, deep dives, and management interviews from listed companies across Europe. Seat11A gives investors direct access to company management and their businesses, strategies, and financial performance. Thank you for watching, and we look forward to welcoming you back soon.
Disclaimer. As described in the legal section on our website, seat11a.com, this publication is for informational purposes only. This means it is not intended to provide you with any investment advice. Any opinion or recommendation expressed by the companies is neither given nor supported by us and should not be considered investment advice from our side. Also, remember that any opinion or recommendation expressed is subject to change without further notice. The content is obtained from sources believed to be reliable, but we do not guarantee its accuracy, completeness, or timeliness. Seat11a.com and its employees disclaim all liability for any loss that may arise in any form from any use of the information in the video, audio, and on our website. We neither express any opinion on the future value of any security or other investment vehicle, nor recommend any investment based on the information provided. Please consider the publications and our website as a platform for companies to present themselves. You need to seek financial advice from an expert regarding the accuracy and appropriateness of the material presented or recommended by the companies in the publication. As we are just considered a publisher, we may hold and trade securities in the presenting company, whether it is a listed or private company. By consuming our content, you agree to these terms and the terms in our legal section on our website.